Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Ari Rastegar. Ari is the founder and CEO of Rastegar Property Company. He's earned a reputation as a thought leader in real estate with his innovative, technology-driven investment strategies. And in just a minute, we're going to speak with Ari about opportunities that Biden's sustainability initiatives will bring. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Ari. Welcome to CREPN Radio.
Thank you for having me.
Well, I'm so grateful you could join us today. I'm looking forward to our talk. Before we get into it, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I'm happy to do it. I'm actually an attorney by trade. I started my first real estate investment company when I was in law school with a $3,000 loan from the father of one of my friends that I went to college with, and started building single family homes at around 5 o'clock in the morning, and driving about 45 minutes to make it to law school, and was a pretty busy few years. And I graduated in 2008 from law school. And right around that timing should tell you kind of what happened to the world and kind of what happened to part of the business. Luckily, I had a great partner and was able to leave with, my hat kind of, in my hand, and, paying back my investors, not making the money I thought I was going to make. For a kid that delivered pizzas through college, it was going to be something pretty great, but I certainly learned a lot, and moved to New York City and spent many years on Wall Street working for some of the greatest minds in the business. Today, Rastegar has invested in over 38 cities, 12 states, 7 asset classes. Our investors are public pension funds, family offices, insurance companies, high net worth individuals. You can find out more about us by a simple Google search. If you just, Google Rastegar, that you can kind of see in the background, or my name, Ari Rastegar, you might see more articles than you bargained for of what we've done. It's been pretty public. And being in 7 different asset classes over the past 6 years under our own banner, we've been very agile. We found a lot of value in discount retail at one point, stuff anchored by Target, TJ Maxx, and Ross. And we did some student housing and did some office, industrial redevelopment. But we see a tremendous amount of opportunity right now in vintage multifamily. And that's really kind of sub 100 doors, very well located properties outside the urban core, very much a post-COVID strategy that we started before COVID even started. Renovating the properties, taking them down to the studs, increasing rents, bringing institutional risk controls in place, and really capitalizing on this renters market. But if you look at, our global portfolio, which is well in the 9 figures, we're breaking ground on 4 major development projects in 2021, including an office building, a small office building on East 8th and I-35. We're based in Austin, Texas, where I was born and raised. We're building some condos in Phoenix, in downtown Phoenix in the Opportunity Zone, 500,000 square feet of industrial near the airport in Austin. In addition to about 150 condos on South First outside the urban core. But our core business is vintage multifamily renovation, certainly for the foreseeable future, being able to capitalize on the accretive financing that Fannie Mae, Freddie Mac, and HUD has provided, being in this kind of low rate interest rate kind of era that we're in. And I see a very, very positive outlook for those asset classes.
That's a quite a list of accomplishments there, and I applaud you from just the start as a student, having the umption enough to get up and go.
I think it was stupidity. I think it was a little bit of brain damage. I don't know if it was intelligence, but the old definition of an entrepreneur is someone that jumps off the side of a cliff and builds a plane on the way down. And that was certainly me. Luckily, I kind of glided, there at the end.
Well, but I think also the important note to that that I encourage people to understand or to dig into or try is recognizing that when you take that risk, I mean, you are empowering yourself at the same time. There's so many people that I think that go to college or go to school, or their ambition is to get a job, and basically they're capped by whatever their employer will pay them. Whereas what I love about real estate is the opportunity is there to create the terms, make the deal, uh, and keep making more deals. And
Right.
for you to start at such an early age and see that opportunity, I think is one it's admirable, and I'm sure you learned a lot even in the downturn on what not to do, and it's probably made you stronger since.
Yeah, well, I think learning what not to do has been much more beneficial. My book is actually coming out in May called The Gift of Failure. And I very much, been a student of my failure and using introspection to understand kind of what went wrong. And early in my career, I found, a lot of ego kind of coming in, wanting to, have the right answer myself. And as the business matured, we're vertically integrated now. We have about 60 construction workers that are full time at our projects, 20 folks in our wholly owned property management company, in addition to the PE firm at Rastegar Property. So we run the whole gambit, right? And you're making mistakes, and it's how you bounce back from them and what you learn from them. But those failures are certainly a gift if you have the resilience to go in and look at them from from a non-biased point of view, and surround yourself with what I call believable people, people that'll really look at the situation and bring believability to whether you're underwriting a deal, whether you're looking at the numbers, and really use mathematics. We see ourselves, as you kind of mentioned, as a technology data analytics company. The joke at Rastegar is that light bulbs don't go out in Rastegar buildings. And I say that because we have chips in all the light bulbs and the water heaters. We quite literally in real time can see if you turned on your microwave inside your unit, and we're collecting all that data, bringing on data scientists to make better investment decisions, and offer a better kind of end user consumer experience. Because at Rastegar, we're very much obsessed with our customers, and those are our tenants in our apartments, tenants in our office buildings, in addition to into our investors. And the better experience that we can provide for them, the better it can be. So yeah, I definitely failed more than most, and kind of in the words of John Maxwell, fail forward. You find that failure, and I think a lot of people try to separate failure from success, and the word failure has this negative connotation and has this baggage that I think is just not fair, because failure is how we learn. Being on the brink of failure and failing is when we actually do find success. And those that I've been very fortunate enough to know, and mentors, whether in books, reading autobiographies, or friends or colleagues, billionaire friends of mine, are the ones that have actually failed the most, but they got back up and they did it again. And I think that's a tried and true concept. And it's something that I'll be talking about a lot of my book, called The Gift of Failure, as I mentioned, coming out in May.
Awesome. I want to ask you quick about the different asset classes.
Sure.
I think that so many people, and it sounds like now you guys are focused on the vintage multifamily, but as you pivoted, or however you went from asset class to asset class, was there a strategy with that, or was there an opportunity that you recognized? How did you make the
Yeah.
decision to go from one to the other?
Well, it's math, right? I mean, and for example, in 2015 and 16, we were investing in discount retail a lot. And then you started to see Amazon and online retailers like, really, really take that void. You started to see big box retailers like the Sears of the world or the J.C. Penney's go dark, and you started to see the writing on the wall and started to really understand the sales per foot. So one of the metrics that we'd look at in retail is, what are the sales per foot against the price per foot that they're paying in rent? And that's called a health ratio. So the higher sales that the area is generating in comparison to the rent that they're paying, will really tell you how solvent that business is. And when we started to see some of those health ratios decline in very stable businesses, in great businesses, great companies, we saw an opportunity to exit, and I've never been scared to sell. So if we find an opportunity to create liquidity, we'll do that. And I've built a business around singles and doubles. I'm not the home run guy. I just rather just kind of just keep getting on base and kind of keep it moving a little bit. But agility has been very, very important, and taking the emotion out of it, understanding the math, but at the same time, handicapping that against the gut instinct, right? I mean, you walk these properties, you see them, you understand the neighborhoods. When we were investing in self-storage, you'd go in there and, you talk to them about renting a unit, you'd walk the area, you get to know management, and it's unbelievable how much you can learn from touring an apartment complex that you want to buy as a prospective tenant, or or a self-storage facility that you want to be a prospective renter, just from speaking to management and putting some of these things in place, in addition to the 70-point due diligence proprietary process that we created over the past 12 years to really understand how we underwrite these deals. And by using our 70-point due diligence checklist, in addition to bringing in a third party to do the due diligence, we separate the two teams together. And then once the two teams are done conducting their diligence without communication, we do almost a Venn diagram. And what we find is that we miss a lot of things and they miss a lot of things. And by putting those things together, you can get to a place where you have a high degree of probability that you're purchasing something that, that would have long-term value.
Now, as an insurance broker, I really appreciate you sharing your due diligence, or a little look into your due diligence, because I think that that's something that I find a lot of newer investors are kind of they may be strong on like one aspect of the due diligence, like the what the guy is reporting is, or what the seller's reporting is rents, and comparing to
Sure.
what the market might be, but not understanding capital improvement budgets,
Sure.
and just whatever else that rocks they don't know to look under, so they don't, and then they get into something and have a problem there. So I appreciate that.
Yeah, that's right. I mean, this is, I'm a risk manager for a living, as you mentioned, being an insurance broker. That's really risk management. People ask me all the time, oh, you're a real estate investor, you're an owner operator. And I'm fortunate in building this business that I still own 100% of the company, starting it from literally from nothing. And my wife works in the company, and my sister-in-law is our chief operating officer. And this is all for my kids. I'm a very, very simple man. I don't wear fancy watches or, kind of anything of that sort. We've obviously built an enormous business, but, we've done it by creating value and doing something really special for our consumers. But I see myself as a risk manager. That's what I do for a living, is I manage risk. And, I don't have a crystal ball. There's, anybody tells you that there's a guarantee or anything of that such, I would cautiously be a little bit weary, because there's no guarantee that I cross the street and don't get hit by a car, God forbid, right? So we do our best to manage risk and run sensitivity analysis and run stress tests and run different scenarios and really focus on what could go wrong. Like, it's very, very rare you'll hear me talk about making money, or how much money could be made in this deal. So much is focused on the downside and understanding what that downside risk is. And and how that plays into the deal. And what we found statistically is the more that we focus on the downside and the more that there's kind of less scenarios that there could be downside risk to have a possible loss, the higher the probability there is of actually generating healthy risk adjusted returns.
Oh, that's so true. If you take care of business there, it'll take care of you. That's good. So let me ask you, you touched on a couple of the different asset classes that you're in. You mentioned that your focus now is on the vintage multifamily.
It is.
Can you speak a little bit to how you landed on that and what the opportunity is you see in the vintage multifamily?
Yeah, so there's a lot of things, right? So during COVID, people were very scared of the urban core for the obvious reasons because of proximity. And it's why that and many other reasons why you're starting to see the demise of Silicon Valley. We're based in Austin, Texas. Recently, you saw Tesla bought 2,000 acres here, Oracle moved their global headquarters, and Austin has really become the new Silicon Valley, in many ways, and it's going to continue to grow. I'm a native Austinite, so I'm, a little bit biased in my love for the city. But when you look at the math, I mean, you have 156 people a day that are moving here, and it's tremendous. And most of them are renters. We have a very young population, and millennials. I'm actually the oldest millennial, which is kind of a funny thing I like to joke about, and that I'm right on the cusp, right? I'm 38 years old, so I'm on the cusp of both, and I'm kind of the API plugin, right? If you use technology terms between kind of the older generation, I'm still kind of the old school that went to undergrad, graduated top of my class, went to law school. My bar is still in good standing, but I understand technology to some degree, and just understanding how those things, really really play into each other, and seeing that millennials mostly are renting. And that doesn't have as much to do with money. A lot of people like to turn that on, that they're not making as much money or jobs aren't as plentiful. And the data actually shows that that's inaccurate. They have the money to be able to purchase things, certainly with interest rates being where they are, but the core values are different. They travel more. I should say we travel more. We're interested in being outdoors and more adventurous, and millennials change jobs more than any other generation in history. So, having a home, or what would have been the American dream to our parents or grandparents, is very different from a core value standpoint. So having that agility and that flexibility will bode well with renters. And another statistic that was unbelievably staggering to me was, if you look at individuals aged 18 to 29 years old as of the 2020 census, over 53% of them are living at home. So when you take that massive population, as in the United States, we actually are a very young population as a whole, 18 to 29 years old living at home, 53%, which is the highest in history. That's what I call shadow demand. So
Right.
once the vaccine really is populated, is really distributed, and we're starting to see that happen, which I think is great, giving people a lot of peace of mind. And once we get over the mental toll that people have gone through during this time, which I think is really understated, and Billy and Jane start kind of moving out of mom and dad's house, they're not moving into the fancy shiny high rise and downtown San Francisco or downtown Austin. They're going to find a nice, suitable place that they can live. And I kind of call it the $5 Uber ride. So if you're within kind of the $5 Uber ride of the restaurants and bars and those things, you're still well within a reasonable and economical proximity to all the places that you want to be. So that's really where the strategy has come from, is that we believe that shadow demand will continue to increase for this older product, because when you buy the older product and you fix it up, you can charge significantly less than new development, because in most instances you're buying at a discount to replacement costs. So you can still hit your margins, you still hit the IRRs that you're looking for, but with that, you're charging much less when it comes to rent. And I believe that trend is going to continue, certainly for the next 5 to 7 years.
So tell me a little bit about you mentioned buying at a discount to replacement costs. You also mentioned you're going in and down to the studs. What does a renovation for you guys look like? Are you, I mean, is it stem to stern? Are you going all the way through the?
Oh, so down to the studs is kind of a term that that you'll hear kind of in kind of industry and what we use, and effectively that means a gut renovation. You're talking new sheetrock, new insulation, doing all the deferred maintenance, changing roofs, plumbing, electrical, and really upgrading the property from a whether a class B or a class C, certainly on an interior basis to an A minus product. So a lot of the interiors that we have, whether it's I mean, it's brand new lighting, brand new HVACs. I mean, you're really getting a class A experience, but the structure itself is kind of like, like kind of the old Motel 6, right? Like you walk up, it's a 2-story walk up or 3-story walk up. Um, in very, very well located areas. So you watch those maintenance costs go down. And a lot of times you can buy these from mom and pops, and the older products have a lot of maintenance issues, which bring that expense ratio up. So when you're able to renovate the interior, you can increase rents. But once you do all that deferred maintenance by changing the roof, there's not as much leaks, the toilets aren't breaking, or whatever variety of issues that happen. And there's always maintenance calls and things that need to be dealt with, but it brings that expense ratio down significantly, which adds to the bottom line. So, saving money on expenses in addition to a raising rent is really how you pop NOI, which in the long term is what is going to ultimately create value.
No, that's you're preaching to the choir there as far as, like I said, an insurance guy and also an investor myself. If you can knock out those capital expenses up front, you can have an
An
efficient
annuity,
property.
you can
Yeah,
create
I
an
mean,
annuity.
yeah, exactly. I mean, a property that's you've basically got the well located property, um, and just to take care of all those problems or potential problems right away to where they're not problems. That's beautiful, and I'm certain from an insurance standpoint that by doing that, your insurance companies are more than happy to insure your risk, knowing that you've done all the system updates as opposed to not, which is more often the case that somebody has come in and they've put new paint on something and made it look all
Or they call it lipstick on the pig, right?
yeah, and I think that as an investor, it's always tough when you're trying to calculate these things if you don't have a kind of a global sense of what is behind the walls and what is it you're buying. If you're solely focused on what you can charge more rent for, that's going to be the new floor coverings and the cabinets and the updated kitchen and bath. But if you're not opening up those walls and replacing those systems in that, um, you're basically setting yourself up for a surprise later and some expense. And so I applaud you for doing that. And is your strategy to hold most of your properties, or how
Yeah,
you said you're
we're
vertically?
long-term holder. We're long-term holders as a general rule. We're certainly not flippers, but it's really on a deal by deal basis. I mean, if there's a deal that we can go in and like I said, create value and hit the returns that we think are feasible for ourselves and our investors, then we're not scared to sell. But there's some properties that certainly that are in like the opportunity zone. As an example, we're building over 500,000 square feet of industrial on the 130 corridor, which is close to Tesla's 2,000 acres next to the airport in Austin. Well, that's in the opportunity zone, and that's a 10-year hold. And so that's the strategy there. So as an example, the condos that we're building in Phoenix and the condos that we're building in Austin, those are built to sell, right? So it's really evaluated on a deal by deal basis of the type of capital that you have in those deals or in those groups. So there's no, exact answer to that question. It's all really evaluated on a deal by deal basis.
Right. No, that makes sense. Hey, I did want to ask you a little bit. Is in the show title or I'd mentioned the initiatives or Biden's initiatives and the opportunities.
Sure.
Um, could you speak to what are the initiatives Biden
Yeah.
has planned and what you see as the opportunities?
Yeah, well, look, I mean, so President-elect Biden is, very, very much into sustainability. Obviously, a lot of the mandates are around, around climate change, around technology, using alternative energy, and using a lot of these things, solar paneling, et cetera, which I think are great, and I think that they can be used prudently in a lot of different ways to create that sustainability. And they work in some instances, they don't work in others, right? And I think there's going to be a balancing act there where certainly we can lower the carbon footprint in a lot of these instances. Austin has done a tremendous job of preserving the green space that's here in Austin. We actually have more public parks than any top 10 city in the United States. And it's very, very difficult to get through zoning and entitlements, which actually, bodes well for real estate values long term, right? So, a lot of those environmental protections, I think, are very, very important. It's all going to be in the execution and how they're financed and how they're used and how those tax credits are used. So, I'm excited to see how they're going to be implemented because I think a lot of the ideas are great. And people ask me all the time, am I a Republican or a Democrat? And, my answer is I'm an American. I see the merit on both sides. I see good ideas on, kind of both party lines. I think both have made some, have some issues that I don't necessarily agree with, but I'm just kind of one opinion. But I think that done right, there's a lot of sustainability concepts that can be implemented that would be a great value add for the country and for cities alike.
We talked just a little bit about managing the risk. Do you see any potential risk with the opportunities that you're, with the sustainability opportunities, or?
Yeah, I mean, there's always risk, right? I mean, there's risk in everything, right? Is the is the generic answer to that. But I think the heart value is in the right place. I think going towards sustainability is where we should be thinking. But again, it all comes back to the execution. How's that going to really be done? Elon Musk is working on a battery that apparently will, never run out, right? Using electricity in different ways versus gasoline and lowering carbon emissions and all these things we've spoke about. I think are all great concepts. And I've seen some some really fabulous things. There's a group called the Ocean Cleanup Plan that was actually founded by a 19-year-old kid several years ago, and he's created a filtration system that's actually can go through and take out the plastics out of the ocean. I mean, literally clean the ocean, and then repurpose a lot of the plastics and a lot of that debris, recycle it, and then reuse it, which is pretty innovative. And I think focusing on a lot of those endeavors in the right way is where the world needs to go. And using working with innovators like that gentleman, like an Elon Musk and folks like that, I think Biden will be very, very supportive of. And I'm excited to kind of see the run that they're going to go on and see those initiatives. But for me, it's always in the execution. It's always in they used to ask Michael Dell years ago about his suppliers and who he uses and how he builds his computers. And he was actually very open about it. He shared a lot of the things where people were shocked, like, oh, you told us where your supplier is, or, kind of this, that, and the other. And I'm, kind of flubbing the quote a little bit, but the net was, he said, look, I can tell you who my suppliers are, exactly what I'm doing, but you can't execute like me. And that's really where this comes down to. So there's a lot of great ideas, a lot of great minds that he's surrounding himself by, but it's going to be in what the execution is.
No, that's well said. Hey, Ari, if we could, I'd like to shift gears here for a second. As I mentioned a couple times here, by day I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And most often, there's three strategies we typically consider. We look to see if we can first avoid the risk. If that's not an option, we look to see if we can minimize the risk. And when neither of these are an option, we look to see if we can transfer the risk. And that's what an insurance policy is.
Sure.
And I like to ask my guests if they can look at their own situation. It could be your clients, your properties, investors, tenants, market, however you want to define it. But if you could take a second and identify what you consider to be the biggest risk, and again, for clarity, I'm not necessarily looking for an insurance related answer, but if you're willing, I'd like to ask you, Ari Rastegar, what is the biggest risk?
The biggest risk is ego, always to me, and I say that in whatever instance that you're working on, as whether as a CEO, as a father, as a husband, early in my career. And I'd like to believe that I've improved on this a little bit. I don't know if my wife would agree with me entirely at home, but the key is looking for the right answer. And we touched on that before. And it's really being collaborative, and it's really, taking yourself out of the equation, because a lot of times I'm not the consumer. So there might be a countertop that I want to install, and I love this red. I'm just using a random color, but I might not be the consumer. And so doing a focus group, asking other believable people, bringing other, using collaboration to find the right answer. And, whether as a father talking to our children, and I might think that, this is the way that I should be talking to them or teaching them or disciplining them, but is that their love language? Is that the way they need to be spoken with? Is that the way that they need to be nurtured? Is that the way that I need to show up for my wife? Does she need me to listen to her, or does she need a solution? And, and really taking myself out of the equation. And that's been one of the biggest evolutions of Rastegar. Is really that's the biggest risk, is when we think we're right. And Mark Twain said it best. He said, it's not what we don't know that gets us in trouble. It's what we know for sure that just ain't so. And I think that's been the biggest learning experience for me, and the thing that I've really focused on. I think some of my childhood friends would, let's say, that was a little bit more of an arrogant man uh, earlier in life. And I'm looking to find a little bit more humility there, but not humility in the sense that I think less of myself, or less confident, but thinking less about myself and thinking more about what that end user consumer is, our investors, the property themselves, the investments themselves, and all the other facets that come together.
Oh, that's great. Hey, Ari, where can the listeners go if they would like to learn more or connect with you?
Yeah, I mean, you can just Google Rastegar. I mean, it's been up there I think at the top behind us most of the time. Or you can Google Rastegar or Ari Rastegar or Rastegar Property. And it's been pretty public. We've been in the Wall Street Journal, New York Times, Forbes, countless times. So it's very, very easy to find us. Our website is just rastegarproperty.com. But a simple Google search you can find us pretty easily. We have some incredible opportunities, if I do say so myself, that could fit some certain people's risk profile. And that's our job, is to serve our consumers and serve our investors. And we'd love to hear from you. Reach out to us, and a human will definitely get back to you. In a lot of instances, I take those phone calls myself, just because I very much love the human element. I was a English major in undergrad, believe it or not. And so I'm very much still a voracious reader, and love the human element, love the conversation, and love that part of the business very, very much. So I really appreciate, you having me today, and letting me kind of spew some of my thoughts.
Well, and we're glad to have you, Ari. I want to say thanks for taking the time to talk. I've enjoyed it, learned a lot, and hope we can do it again soon.
Look forward to it very much. Thank you so much.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.